You're watching CapitalCosm Live. My name is Danny. Today's headline is Jamie Dimon says a crack in the bond market is going to happen. This is from Bloomberg AI. It says Jamie Dimon warns that a crack in the bond market is going to happen due to the U.S. government and Federal Reserve massively overdoing spending and quantitative easing. We're going to look at a number of charts that kind of bolster Jamie Dimon's warning. Something weird has been going on, most particularly since 2022. 2022, it appears is when things started to break. It appears that when things that have been correlated with one another were no longer the case. We have some very interesting charts that I don't think anyone else has pointed out, at least not anyone that I've seen. Maybe I reinvented the wheel. Who knows? But be sure to check it out. We have a great episode coming up for you guys. This is a live stream after all, so hit that like and subscribe, comment in the chat room. It does help boost us in the algorithm with these live streams. So much appreciated here, guys. All right, let's dive right into this summary. It also says Jamie Dimon expresses concern about the trajectory of the debt and the ability of market makers to make markets hoping for a change before a crisis occurs. Dimon expects a kerfuffle in the Treasury market that will prompt a Fed intervention and advises regulators to take action to prevent a panic. So let's go ahead and dive into some of these charts. And we do have a monthly close on the S&P, and that's what we're going to kick it off with, is that monthly close. Now, the month before that, we had that big Liberation Day sell-off, and you can kind of see what the candlestick did here. The sellers brought this thing all the way down to the $4,800 level, but the buyers were able to surmount what seemed the insurmountable. The buyers brought this thing up right back to where it started just about. And this month, we had a big green candlestick. So if things been rebounding, we'll get into that here in a second. It does appear that according to our AI model, it still thinks we're still in an uptrend. It's, you have this regression line that's been green for quite some time now, since 2012 on the monthly candlesticks, and it's been going nowhere but up. And so this minor hiccup that we saw here last month and in 2020, you can kind of see that as a pit stop to the downside, but nothing more than that. What's interesting is that if you look at the S&P, I'm going to minimize this part here in a second. So we have been hitting all-time highs, or not lately, but that has been the pattern over the course of the last decades, I should say. But when you price the S&P in gold terms, what you'll realize is that we hit an all-time high. The last all-time high we hit was in 2000, July of 2000. So that was a dot-com bust. We haven't made new all-time highs. We have made new all-time highs if you price the S&P in fiat, in dollars. But when you price it in gold, this is what the story tells. It's not truly the case. And what's fascinating here is that if you look at the S&P down below priced in dollars versus the S&P priced in gold, you'll realize that in 1930, this is the cool thing about this chart, in 1929, when the S&P got overpriced in gold terms, the chart below, which is the S&P in dollar terms, began falling down with it. And they kind of track one another, but it really wasn't until the 1970s is when you started, or the 1980s, I should say, is when the S&P bottomed in gold terms and the S&P in dollar terms kept going up. And they diverged sometime in 2000 towards the dot-com bust. And that's when everything started kind of changing, let's say. When the S&P crashed in gold terms, it crashed as well in dollar terms, but not as much. And then it continued its rise on up. Although we've been in a consolidating pattern here since October of 2018. As you can see, we've just been kind of moving sideways, but in dollar terms, it's been going nowhere but up. Now, here's the interesting part. So we've got the S&P here at the top. I'm just going to take this out. We've got the S&P here at the top, and then I've got the 10-year yield down at the bottom. And obviously, maybe some of you might not know, but the 10-year yield has been in a bear market, or bonds have been in a bull market, which means the yield comes down as a result. Up until somewhere around here, March of 2022, yields have broken out of this pattern that's been formed since 1980. Now we've had this downward pattern since 1980, this downward funnel, or just about, and we broke through it. And something weird has happened. So what you'll notice is that with the S&P, it's inversely correlated with the 10-year yield. So when the S&P goes up, this goes down. But what you've seen since 2022 is that not only have yields gone up, which is bearish bonds, but so has the market. And you could also make the case that it actually started in 2020, because this thing started going up here, and in similar fashion, the S&P did as well. But it wasn't until 2022 that you had this massive breakout from this 40-year plus pattern that's been formed on the 10-year yield. Now, when you look at the copper to gold ratio, and the reason why the copper to gold ratio is so important, copper is an industrial metal. It's called Dr. Copper for a reason. Dr. Copper, the copper price, God, I've said copper so many times. Copper is a proxy for the health of the economy. Gold is an asset that's traded on fear. I know that's not always the case, but there's a large component to it that is just that. It is indeed traded on fear. So when the copper to gold ratio goes up, that's usually bullish for the economy. It means that there's more capital fleeing towards industry as opposed to towards gold because of a need to have a crisis hedge. Now we've included the 10-year yield down below here as well. And again, what you'll notice is that when you look at the copper to gold ratio against the 10-year yield, more specifically, over the last, since 2008, they do appear to be tracking one another. When one goes up, the other goes up with it. And one goes down. When one goes down, the other one goes down with it as well. And similarly, when the 10-year yield consolidates, as does the ratio. And we also had that same pattern. We also had that same pattern play out here from 2019 all the way down to the crash of 2020. And then finally, from 2020 to 2022. So you had a big move up in the copper to gold ratio somewhere around May 2021, and it stayed at that level until March of 2022, right? Kind of stayed at that consolidated level since March of 2022. But what's fascinating is that the copper to gold ratio has been coming down, but the yields have continued to rise on up. So the correlation has been broken. Someone screwed up something. There's something in the system that's messed up. The 10-year yield is completely going against decades-long correlations in the copper to gold ratio, in the S&P. And it all coincides with this breakout in 2022, August of 2022, May of 2022. That's a number of things happened in 2022. You had the Ukraine war start. You had quantitative tightening begin to kick off with the Fed. So something has broken within the system. Is this what Jamie Dimon is alluding to? And I see we've got a number of people in the chat here. I will be reading your chats at towards the end of the live stream. So drop me any questions you have. I won't be able to get to all of them. Yesterday, I tried to get to all of them, but there were just way too many. But if you'd like to drop a super chat, I'll for sure read it. But if not, I'll just randomly pick a few questions from the chat room. So let's get back into what we're talking about here. Here's another fascinating chart to look at. So on the top side, you've got the S&P. You've got the S&P versus the Nasdaq. So as you can see, the S&P has been largely underperforming the Nasdaq. When this chart goes down, it means the Nasdaq is overperforming the S&P, and then when it goes up, it's vice versa, right? It means that the S&P is overperforming the Nasdaq, and this is what we had. This is what we had. Oops. This is what we had here. This is your 2000s.com bust when the Nasdaq, well, both the S&P and the Nasdaq fell, but the Nasdaq took the brunt of it. And so from a relative standpoint, the S&P outperformed the Nasdaq here for a couple years. This is the .com bust. But that was mainly the exception to the rule. I mean, if you look at this chart here, going back to 1991, the trend has been down. You've been in a downtrend in the S&P versus the Nasdaq. Growth has been outperforming everything everything S&P related. And then below, again, we have our 10-year yield. And what's also, you see a very distinct pattern here. You can clearly see the downtrend. Both charts track one another's downtrend all the way up until a certain point. And I think you guys know what I'm getting at. Somewhere around here in October of 2022, the S&P popped against the Nasdaq, and then shortly thereafter, the ratio began to fall. However, the yield did not. The yield continued to rise on up, even though prior to 2022, the pattern, the correlation was still intact. You had a rising S&P to Nasdaq ratio, and you had a rising 10-year yield. But something happened in 2022. I believe something happened in 2022, and this probably goes back to what Jamie Dimon is alluding to. It's taken 3 years to play out. Nothing happens in a day, but let me know your guys' thoughts. What do you think of all this? What do you think happened in 2022 to cause this dislocation in the market? The market seems rather detached. Something is up. And I don't believe anyone's looked at these charts in this particular way. But ever since that breakout in the 10-year yield, it appears that the yield is artificially high. There's something propping up the yield, and the yield actually wants to come down. So what's going on in the bond market? Very weird stuff. Jamie Dimon did allude to, let's go back to the quote here. Where is it? Okay, so expects kerfuffle in the treasury market that will prompt a Fed intervention. So what does that mean? Obviously, money printing. Let's go ahead and turn this off. Let's take a look at our M2 money supply. Last time I checked, oh, there it is. You're seeing a rebound in the M2 money supply. The money printing is actually kicked back up, and it's kicked back up for a year and a half now, since November of 2023. So the Fed is ahead. I don't want to say the Fed is ahead of the curve, but something is happening to the money supply that is giving us a warning sign. Why are yields spiking so inorganically? Why is Jamie Dimon warning people about it? Why is the M2 money supply spiking back up? Now, I've heard arguments about the M2 money supply being not accounting for treasury holdings. So, when yields spiked up to 5%, and you get a 5% return annually just by investing in T-bonds. A lot of people just pulled their money out of their bank, and all of the other places where M2 money supply is accounting for the money supply and put it into treasuries, which are not accounted in M2 money supply. So the drop in M2 money supply down here, well, you could probably explain it away in terms of people pulling their money and putting it into treasuries. And is that reversing now? Are treasuries getting a sell? Are they not able to find a bid, and therefore yields are rising? So let me know what you guys think. Something very interesting is happening here. Before we get into our chats, I want to give a quick shout out to our good partners over at the Trends Journal. Gerald Salente, one of my good friends here on the channel. Check out his Trends Journal. They cover a whole host of topics in super, super in-depth fashion. I mean, you're going to get trends relating to on the economic and market front, trends on the global economic front, the Ukraine war trend, featured trend guest article, trends in technocracy, trends in cryptos, trends in the COVID war, trends in geopolitics, trends I view, trends in high tech science. And you get a special 10% discount to the journal if you click the link down in the description box or the pinned comment down below. So highly recommend it. Gerald and his team do a fantastic job in distilling all the key trends that you need to be aware of, because in this day and age, I mean, there's just so much to absorb. And a lot of us have jobs. We have businesses we run. We don't necessarily, I mean, my job is to keep in touch with all this stuff. But for normal people that don't work in this line of work, Gerald helps in distilling. He's kind of like your outsourced research team. I know I've used that analogy many times before, but that's exactly what the case is. So get your 10% off discount by clicking on the link down below. Okay, let's go ahead and check out what you guys had to say here. All right, so 3 thumbs up. Wow, thank you. Fat, can't really read that. Fat Pine grew an extra hand. Nice. Let them eat crypto. Yeah. I wonder what Bitcoin's. I mean, Bitcoin has been stuck at the. I know I've seen some arguments being made. I'm not a big Bitcoin guy, but I've seen some arguments being made that when you look at the Bitcoin channel, let's go ahead and take a look at that. Actually, it's been decreasing. The acceleration's actually been decreasing. So you can kind of see the arc start to form, right? Right. So some have made the argument that it's hit its fourth Elliott wave hump, and that's indicative of the end of the current price spike, price movement pattern that Bitcoin's enjoyed since 2013. I don't know about that, but let me know what you guys think. Very interesting. All right, let's see what else we have here. Sergio, I see your comment. I don't know if I can post that on the video. It might be a little inappropriate. Okay. Lynette says JP Morgan is in bed with China. Are they? I know Jamie Dimon kind of acts like a surrogate State Department head by cutting deals with, by acting as a diplomat between the U.S. and China. So maybe. Programmable CBDC will boost demand. Kevin, good question here, Kevin. Hey, Danny, any tips, resources on how to learn better charting interpretation of charts? That's a good question. I started getting into this stuff. I used to watch some of the some of my favorite charting people. Andy from Finding Value, he'll be on tomorrow. I also used to watch, and I still do, the North Star Bat Charts folks, Patrick Kareem and Kevin Wadsworth. I used to watch their stuff. Uselink, I used to watch him. The Market Sniper is really good at it. So I used to watch a lot of these guys in action. And after enough reps, you just start to pick up on it. That's just the way my mind works. I get very obsessive. I really got into, really heavy into technical analysis back in 2000. No, 2020, I should say. Sorry, not 2000. I'm still fairly young. But 2020, and I became like a madman. I just absorbed so much content, read so many newsletters. And that's just the way my personality is. I have addictive tendencies. So whenever I find something fascinating, I just go balls deep, pardon the language, into it. So the way I did it, I just watched a bunch of content from people that I sensed were, knew what they were doing, and just absorbed their work. And what you could also do is you can Google chart patterns on Google image search, and it'll give you like a ton of like different patterns to look out for in terms of determining whether something bullish, bearish, or neutral. That's a great help too in determining candlestick patterns. I think that's another thing people don't take into account is candlesticks. I see a lot of chart readers that look at trend lines, but the candlesticks are also important because it tells you it's effectively telling you, it's distilling information on the behavior of the herd. So, for example, when you look at something like, God, why is this always selected on the brush tab? Okay, so take this candlestick here. Take this candlestick here. What this tells you is that the sellers brought, Bitcoin down to 3,700 back in 2020, but the buyers were able to bring it back up. Now, this isn't a clear hammer pattern. It needs to be a little higher, but if it was, it would tell you that sellers were rejected at this level and were overwhelmed by buyers. That is a bullish signal to further upside. And look what happened the next month. You had a green candlestick. So it's things like that. And in technical analysis, it's not 100% accurate. So, some have said it's 60% accurate. There is a margin, so to speak, but you don't need to be 100% accurate to be a successful investor. You don't even need to be 70% accurate or even 60% accurate. If you can be 55% accurate or, somewhere around over 50%. Some have even said over, maybe you can be less than 50% depending on, if you're investing in asymmetric trades, right? And if you get 100-bagger and you lose the rest of your positions, well, that 100-bagger or that 10-bagger makes up for the losses. So there's many different ways to skin a cat. Good question. All right, let's see. What else do we have here? Neil, M2 Money Supply is printing since 2023. Yep, that's exactly what we looked at. Eddie, what if China is dumping? Or well, if China, I think you meant what if China is dumping? I think they've been slowly dumping. They haven't dumped all at once, but they've been on a trend where they have been dumping bonds, U.S. Treasury bonds. All right. Anything else? Let's see what else we have here. Eddie also says, Fed says very good right now. Well, I guess pack it up, guys. I guess happy days are here again. Let's see here. This is from Ian McIntosh. Francis Hunt, the market sniper, has been expressing his views about the bond market for 4 years now, at least. Yeah, I actually need to get Francis back on. Current week is currently booked up, but I'll see if I can get him on the next week. We need a good update from him. And I don't think we have any. Yeah, we have a lot more. I'll read one more. All right, let's see what else. Sweeping says highest monthly close ever on Biddy. I'm assuming you mean Bitcoin by that. The controllers are in it for some reason. Possibly, yeah. And I think that's I'll take one more. Lynette also says, watch Japan, not China. Yeah, that's one thing we haven't looked at. Maybe we'll look at it some other time. It's the Japanese bond market, which has been, you thought these yields were high. Wait till you see Japan's yields. So, all right, guys, thank you so much for watching. If you enjoyed this content, drop us a like, comment what you think. What do you think broke in 2022? Do you think Jamie Dimon is to be trusted in this case, or is he talking his book? Because some people may say that, but by looking at the charts, something is indeed broken in the bond market, and it's been broken since 2022. So drop me your thoughts down below. Let me know what you guys think, and I will catch you in the next episode. Like, subscribe, do all the YouTube stuff. Also, check us out on Substack as well. CapitalCosm.substack.com. Get early access to all my videos, ad-free versions, all that good stuff. All right, guys. See ya.